Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Dollar General Corporation, ticker symbol DG. So we're looking at Dollar General today as a subscriber request. While the S&P 500 is down over the past year, Dollar General is actually up 6%. So we want to find out, what are we missing? What could the market have possibly discovered about this business this year that's led to this kind of outperformance? So right now, Dollar General is trading for $248.57 per share. Over the last 5 years, Dollar General is compounding at a rate of 21% annually. Over 10 years, they're compounding at a rate of 18.5% annually. And going back to when they were a publicly listed business, over the last 13 years, Dollar General has compounded at a rate of nearly 20% annually. Keep in mind that they've also paid out dividends throughout this period. Right now, they have about a 0.9% dividend yield. So while that is below the yield of an S&P 500 ETF, that would be in addition to this compounded annual return. So Dollar General is currently trading about $14 below their 52-week high. They're up more than $60 from their 52-week low. Dollar General is a large business. They have about a $55.5 billion market cap. So for additional background about the company, a leading American discount retailer, Dollar General operates over 18,000 stores in 47 states, selling branded and private label products across a wide variety of categories. In fiscal 2021, 77% of net sales came from consumables, including paper and cleaning products, packaged and perishable food, tobacco, and health and beauty items. 12% of sales came from seasonal merchandise such as toys, greeting cards, decorations, and gardening supplies. 7% came from home products, which include kitchen supplies, small appliances, and cookware, and 4% of sales came from basic apparel. Dollar General stores average roughly 7,400 square feet, and about 75% of Dollar General locations are in towns of 20,000 or fewer people. The firm emphasizes value with most of its items sold at everyday low prices of $5 or less. The company was formerly known as J.L. Turner & Sons, Inc. and changed its name to Dollar General Corporation in 1968. Dollar General was founded in 1939 and is based in Goodlettsville, Tennessee. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Dollar General based off of their business fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public, so we'll continue to improve and get better over time. With that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. And there are 2 key reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. The second reason is that the average publicly listed business earns about a 7% return on capital. So by looking for a benchmark of 14% or higher here, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. So Dollar General's return on capital have declined somewhat over this time frame. Over their last 12 months, they've earned about 13.5% returns on capital, but they haven't dipped below 12%, which was the lowest that they got to in fiscal 2020. And averaged out over this period, Dollar General is earning about 17% average returns on capital. That's coming in above that benchmark and more than double that of a typical business. So this is a check to start things off here on metric number 1. Next up, for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for revenue, net income, and free cash flow growth over the last 5 years. This metric is going to be all or nothing in nature, and either all 3 of these are going to be up for this to be a check, or if even one of these is down, this entire metric will be an X. We'll also be including their last 12 months worth of numbers in our calculations here. So over this time, Dollar General has grown their revenues by about 55%. Their earnings are also up more than 53%. However, the business runs into trouble over their last 12 months, with their free cash flows being down by 55% from where they were at in their fiscal 2018. So while they did grow their free cash flows between all 5 of these fiscal years, again, over their last 12 months, these are down, meaning that this is going to be an X on metric number 2. This is especially concerning because free cash flow is really the lifeblood of any business, and a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is what that business is going to be worth. So a business can use its free cash flows to reinvest back in the business, make acquisitions, buy back shares, pay down debt, or pay dividends. So again, not great to see that their free cash flows are down more recently. This free cash flow decline is coming on the back of a $2.2 billion change in inventories, as well as higher capex in the business overall. Next up, for metric number 3, here we're taking the perspective of an individual shareholder by looking at Dollar General on a per share basis. So we're looking for earnings per share growth over the last 5 years. So over this time, as we learned in our previous metric, their earnings are up by more than 50%. And additionally, Dollar General has repurchased around 16% of their shares outstanding. So this is likely a good sign for long-term shareholders in the business, because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. And when a business buys back shares by decreasing the amount of stock that they have outstanding, they're increasing your ownership percentage in the business, which is ultimately going to increase the percentage of the business's profits that you're entitled to without you having to spend a dime. So it's almost as if the company is making a partial acquisition of itself. And so just like with any other acquisition, we want the company to be getting more value than the price that they're paying. In practical terms, this means that we want companies buying back stock when it looks like it's an attractive use of their capital and they're trading below their intrinsic value. So to determine whether or not that's going to be potentially the case, you'd have to dig in and learn more about the company. But between their earnings growth over a smaller number of shares outstanding, this is strong earnings per share growth here for Dollar General. And this is our second check of the day coming in here on metric number 3. Next up, metric number 4 is going to be very similar. Here we're looking for free cash flow per share growth over the last 5 years. Again, it looks like they've grown this over their last 5 fiscal years. However, because of that $2.2 billion change in their inventories and because of their higher capex over their last 12 months, their free cash flows are actually down over this period by more than 50%. And unfortunately, their free cash flow declines have outpaced their buybacks over this time frame, meaning that Dollar General's free cash flows are down over this period. They've earned about $2.28 worth of free cash flow over their last 12 months. And so this is an X here on metric number 4. So far through our first 4 metrics, we're split evenly. We have 2 checks and 2 X's for Dollar General. Then next up for metric number 5, here we're evaluating how the business is utilizing debt. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. So we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that they produced over the last 5 years. So Dollar General ended their fiscal 2022 with $13.9 billion worth of net debt. Since then, they've increased this, and right now they have $16 billion worth of net debt. However, because they're a retailer, their net debt position is going to be a little different from that of a typical business. The reason it looks like they added on so much net debt between 2019 and 2020 was because they started including their capital leases in this net debt, and they broke those out. So of their current $16 billion worth of net debt, $9 billion of that comes from capital leases. So if we were to make an adjustment and exclude that, realistically, it looks like they have about a $7 billion net debt position. And over these last 5 years, Dollar General has produced about $8.7 billion worth of free cash flow, meaning that because of this adjustment, this is actually going to be a check here on metric number 5. Again, you'll want to do your own research to understand if that's going to be potentially appropriate for the business or not, but it is a difference between retailers and other types of businesses. Again, one concerning sign here for Dollar General is that their free cash flows over their last 12 months are down significantly from what they've been at over these last 5 fiscal years due to their higher capex and their change in inventories. If we were to extrapolate their last 12 months of free cash flow, it does not look like they'd be able to support this debt load with or without that capital lease adjustment. So again, understanding where Dollar General is going to be at in terms of their free cash flows is really just going to require a deeper knowledge of the business. Then our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will potentially give us a slight risk premium to the yield of the 10-year treasury, and it'll give us a reasonable starting point for evaluation of the business. We're using total enterprise value because it takes into account both their market cap and their net debt position, and it's going to give us a perspective of the economic reality of their business that's more similar to as if Dollar General were a private company. So right now, Dollar General has just under a $72 billion total enterprise value, and we learned that over the last 5 years, Dollar General has produced $8.7 billion worth of free cash flow, meaning that in an average year, they're producing about $1.7 billion worth of free cash flow. So when we divide their $1.7 billion of their average free cash flow by their nearly $72 billion total enterprise value, that only gives us about a 2.4% average free cash flow to enterprise value yield for the business right now. So that's less than half of that 5% benchmark we're ideally looking for, and that's also coming in below the yield of the 10-year treasury. So on an average basis of their historical free cash flows, this is an X here on metric number 6. As it doesn't look like their business is currently offering us that risk premium we're looking for. On a current free cash flow to enterprise value yield, Dollar General looks a lot worse. When we divide their $518 million of their last 12 months of free cash flow by their $72 billion total enterprise value, that only gives us about a 0.7% current free cash flow to enterprise value yield for the business. Again, because of those changes, which some of them may potentially just be one-time changes, their current free cash flow to enterprise value yield is likely not looking attractive compared to the yield of the 10-year treasury. Just because this is an X here on both an average and a current basis of their free cash flows doesn't mean that you're necessarily going to throw out Dollar General in its entirety. It just means that the business is likely going through a rough patch right now and that its cash flows are being more fully priced by the market. This analysis is not financial advice, and it's meant to be a holistic understanding of Dollar General. So this is just one of our 6 metrics, and while these metrics are simple, when they're combined together, they can be very powerful. Then as a bonus, here we're looking at Dollar General's dividend profile. So right now, Dollar General pays out a 0.9% dividend yield, which is below that of the yield of an S&P 500 ETF. Dollar General has consecutively increased their dividend payouts for each of the past 5 years. Through their buybacks and their increased dividends, they're increasing their dividend payouts per share. And even with their significantly reduced free cash flows over their last 12 months, in all 5 of these fiscal years and over their last 12 months, they've been able to support their dividend payouts with their free cash flows. It does look like Dollar General has a healthy and sustainable dividend, and that it's been well supported by their cash flows in all 5 of these fiscal years. And while there's a little more pressure on it over their last 12 months, it looks like it was supported by those free cash flows as well. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze Dollar General, which takes us on to using a discounted cash flow model to come to a potential fair value for Dollar General. So a discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. So here we're starting with an average of their free cash flows over their last 5 years. So please keep in mind that this is significantly above what their current free cash flows are at because of the recent difficulties of the business, although this is hopefully giving us a more normalized perspective of their free cash flows over time. Then we're using historical growth assumptions to project these average free cash flows out into the future. So it's up to you to do your own homework to determine whether or not these historical growth assumptions are going to be potentially accurate and applicable going forward to give us a baseline projected estimate for Dollar General over the next 20 years or so. So these historical growth assumptions date back all the way till 1990. So assuming that Dollar General grows their average free cash flows at a rate of 15.5% annually over the next 10 years, then assuming a terminal stage for the business where this growth rate is cut in half for the 10 years out after that, if we add in their tangible book value today and we were seeking a potential 10% rate of return from Dollar General, then it looks like a fair value for their business is right around $189 per share. So that's about $60 below what their current stock price is at. Using these same historical growth assumptions, it looks like from today's valuations, you could reasonably expect about a 7% rate of return going forward for Dollar General. Keep in mind that both of these discount rates would be including their dividend yield, so we would not be doubly counting their dividends. And again, that these average free cash flows are significantly above what their current free cash flows are at right now. So again, that really goes back to it's important to do your own work and dive deeper into the business here. So please be mindful of the fact that this analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in just a minute, we'll talk about our summary for Dollar General, but we have to address something first. What are some of the qualitative aspects of this business, especially those around the key points for a potential long or potential short thesis of Dollar General? So starting with some of the key points around a potential long thesis for the business, with a consumables heavy lineup and potential to capture trade down sales, Dollar General should largely sidestep the adverse economic consequences of inflation and a softening economy. Number 2, Dollar General capitalizes on a broad network of stores, which include rural locations that are often the only convenient sizable retailer. And number 3, low prices and average ticket sizes protect the dollar store segment from digital incursion as shipping costs are difficult to absorb, all while allowing firms to sell smaller package sizes at higher margins. Then for some of the key points around a potential short thesis of the company, number 1, expansion into suburban and urban areas exposes Dollar General to greater competition from mass merchandisers, convenience stores, and other outlets. Number 2, digital and omnichannel retailers building distribution cost leverage stands to make smaller orders delivered to far-flung areas more economical, potentially diminishing Dollar General's standing in a world of negligible switching costs. And number 3, competition in the retail sector is intensifying, with digital and conventional retailers attempting to meet rising consumer expectations. So Dollar General is also undergoing management changes. So hopefully this offers a balanced perspective around some of the key qualitative aspects of a potential long and a potential short thesis for the business. Now it's time for our wrap-up. So in summary, Dollar General checks the box on 3 out of 6 of our metrics. They're earning average returns on capital of about 17%, although these have declined somewhat over the last 5 years. While their revenues and earnings are strongly up, their free cash flows are down due to a $2.2 billion change in their inventories and higher capital expenditures over their last year. The company at the same time, though, has bought back 16% of their shares outstanding, which could benefit long-term shareholders in the business. Then when we made the adjustment to exclude their capital leases, it does look like the company is able to support its debt based off their historical abilities to produce free cash flows. However, that would not be the case looking at their current free cash flows. For both their current free cash flows and their average free cash flows, when we look at that to their enterprise value and we compare that yield to the yield of the 10-year treasury, it does not look like Dollar General is offering us that ideal risk premium of 5% that we'd be looking for. And then even despite their recent cash flow woes, the company has supported their dividends, and they've supported an increasing dividend in each of the past 5 years and over their last 12 months as well. Then finally, performing a discounted cash flow analysis of Dollar General. If you've done the work and you believe that those historical growth assumptions are going to be accurate and applicable for the business going forward, then it looks like from today's prices, you could reasonably expect about a 7% rate of return going forward for Dollar General. That again, though, would be far below what their performance has been like since becoming a publicly listed business. That was also using their average free cash flows, which are significantly above what their current free cash flows are at. So there are reasons why this might not be potentially the case for the business going forward. So it's worth reiterating that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about Dollar General. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $99. That's only 27 cents per day through my referral link down in the description below. Normally, premium is $239, but they are currently running a general offer for $119. But if you use my link, it's only $99. So check it out if you're interested. So as a value investor, you're ultimately trying to conduct this research as if you're going to own 100% of a business, and you can truly understand the underlying essence of that business and understand what's important and what's not important for the company going forward. Through this deeper research, you'll learn more about the qualitative and the quantitative aspects of Dollar General, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for Dollar General will be. So with that said, that's it for today's fundamental stock analysis of Dollar General Corporation, ticker symbol DG. Again, we looked at the business as a subscriber request today, so I'm happy to make an analysis of the company. So if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Dollar General with me, and have a great day.